Welcome to another video on this channel where we talk about things related to payment cards. In my first video of this playlist, I mentioned 6 forms of payment or value exchange: barter, cash, e-transfer, payment card, check, and financing. In this video, we will revisit that list of payment methods. I'm going to change the order of the list a bit to reflect how consumers have experienced the changing payment methods. We're going to find that each of these payment methods has venues where it works better than any other payment method. We will also find that each has its own strength, the good. Each has its own weakness, the bad. And each has its own ugly side. It is important to understand these payment methods. No matter what your involvement in the card payment industry, each of these will be a part of your world as a concept or as a product offering. The lists I provide in this video are far from exhaustive. Feel free to add your candidates to these lists in the comments below. Let's go to the lists. Barter is the exchange of goods or services of similar value between two parties. Barter may be the oldest transaction currency in human history. While being very historic, it is far from obsolete. Here are some current examples of barter. Collectibles, for example, 2 children trading comic books. Trades and skills, 2 contractors exchanging framing work for electrical work. Sweat equity, this can be used in startups to provide some ownership position in return for unpaid or underpaid work. Product for review exchanges, these are programs where manufacturers or retailers give products to people who will provide an in-depth review in return. That is a barter transaction. I'm going to exclude organized multi-party barter exchanges as they exchange credits, not skills or products. Credits are monetary notes used in place of fiat currency. This is a hybrid barter/cash environment, not pure barter. The good. Number 1, barter operates independently of any other transaction currency. Even if I have no monetary assets, through barter, I can get value directly from my non-monetized assets. For example, during the Great Depression, people would do odd jobs in exchange for a meal or a place to sleep. Number 2, the internet and IT-related skills have given barter an expanded geography. I can now create a barter transaction with a person in another country if we are exchanging web-based skills or products. Number 3, barter usually avoids official contract documentation and therefore is often seen as a tax avoidance strategy. However, in the ugly list, we will see the flip side of this point. The bad. Number 1, if I don't have the needed skill or product, I have no value to barter with my intended counterpart in the transaction. Number 2, barter is limited geographically to where I can provide or receive the bartered goods or service. This is especially true for barter transactions in physical skills like the construction trade. Number 3, though barter is good for 2-party transactions, it can get very messy if the exchange involves more than 2 parties. For example, if I provide you with good quality training in exchange for you sending good quality product to a third person, then that third person in turn does a terrible job fixing my car, now we have a problem. The ugly. Barter transactions are taxable. I am based in Canada, so I checked with the Canada Review Agency website. They say, yes, barter transactions need to assign an appropriate monetary value to be reported as income and expense. Good luck with that. Number 2, disputes are difficult to quantify and remedy when there is no stated monetary value for the exchange. As barters tend to keep away from documentation and contracts, the defined value of the transaction often remains blurry. Cash is the use of fiat currency to pay for a transaction. Fiat currency is the government-issued currency for a specific jurisdiction, usually a specific country, except for a currency like the euro, which applies to a multi-country jurisdiction. Cash offers more portability than barter. Because of cash, I can provide my product or skill to one person. That person pays me in a transportable value, cash. I can then use that cash to purchase something from someone who doesn't need the skill I have to barter. Ah, you say, but transportable value can be done with cash, payment cards, or e-transfer. Yes, that is true, and it brings up a very important point. As each of these payment methods have developed, They have embraced the positives of the previous payment method while attempting to remove the negatives of the previous payment method. Next time someone e-transfers you funds, thank cash for inventing that functionality. The good. Number 1, fiat currency, cash, contains a defined value. It is worth what it says it is worth. Number 2, cash requires little or no technology at the point of interaction. I hand you the cash, you hand me the product, and our transaction is complete. Number 3, cash has a recognized value in every merchant in its home country. Where my barter equity has value in a few places, my cash is good at every merchant. The bad. Number 1, most currencies are useless for out-of-country spend. A very few currencies, like the US dollar and the euro, do have more international acceptance. Most currencies, however, are only accepted in their country of issuance. Number 2, cash requires significant infrastructure and cost away from the transaction. This includes equipment and time expenses for counting cash, reconciling cash to the goods or services dispensed, secured cash transport, banking fees for handling cash. These make cash more expensive away from the transaction than in the transaction. Number 3, cash cannot stretch to cover an unexpected expense. If I don't have enough cash in my pocket, I have to leave the store without the merchandise. The ugly. Number 1, cash transactions do not document themselves. Without a separate invoice or receipt, cash is an anonymous transaction method. This may be good for the black market, but it was terrible for me after a major renovation project. I discovered a few $1,000s of cash expenses. They had no official receipts, so I can't claim them on my taxes. In third world countries, this lack of documentation is even more devastating. Countries borrow money. Their ability to get a loan or to get a good rate on a loan is in part dependent on their documented gross domestic product or GDP. In some countries, 50 to 80% of their economy may be cash-driven black market. As it is not documented, to the loan provider, it does not exist. Therefore, the loan application is declined, or, if approved, the interest rate is much higher than it could have been if the full economy were documented. Number 2, when cash is destroyed, its value disappears. Set fire to a $100 bill, and that value literally goes up in smoke. Number 3, currency conversion gets expensive. Buy-sell spreads, service fees, and other costs devalue converted cash quickly. Have you ever come home from a vacation with $20 of foreign currency in your wallet? It almost isn't worth it to convert it back to your home currency. You lose so much of it to the conversion rates and fees. A check is a written instruction from an account holder to their financial institution to provide the documented amount from the cardholder's checking account to the individual or company the check is made out to. The good. Number 1, a check was good in its day. It removed the limitation of not having enough cash for a purchase or having to carry a large quantity of cash for a major purchase. Number 2, check is a promise to pay. It is a legal document. Number 3, check processing costs have come down over the years, and things like e-deposit have made check cashing faster. The bad. Number 1, checks are a fraudster's walk in the park. They are a fraud magnet. Number 2, checks are a promise to pay, but not a guarantee of payment. Rubber checks, officially known as not sufficient funds, are checks promising to pay money that isn't in the funding account. Rubber checks have been a comedy trope for decades, but to merchants they are expensive. They're risky, as the merchant must now get their money from the customer some other way and long after the transaction is completed. They're also a source of fraud. As we said in the previous point, check fraud is child's play. Number 3, there's no foolproof way for a merchant to validate a check. Some merchants, like real estate companies and car dealerships, require certified checks, but even these can be fraudulent. Certified checks probably cause more inconvenience and expense to the customer than being a surefire fraud mitigation for the merchant. The ugly. Number 1, check processing is expensive and slow, It always will be. Number 2, checks are obsolete, but these dinosaurs just haven't had a convenient ice age to take them out of existence. Number 3, banks, at least in my country, keep using their check processes for some funds transfers between institutions. They seem intent on keeping this dinosaur alive. A payment card is typically attached to a line of credit, as a credit card, a deposit account, as a debit card, or to a pre-funded account, as a prepaid card. Payment cards have a fairly complex payment path. There are implications to that fact. You can watch my video on Where Does a Transaction Go for a more detailed description of the payment card transaction path. The good. Number 1, payment cards have gained an almost ubiquitous acceptance footprint at large and medium-sized merchants over the years. Number 2, for cards affiliated with international networks, currency conversion is built into the transaction. Therefore, these cards work in many countries and many currencies. Number 3, payment card has become one of the standard payment methods for non-face-to-face transactions like e-commerce and phone orders. Number 4, an approved payment card transaction provides the merchant with a guarantee of payment. This approval tells the merchant that the account is funded for the transaction and that those funds will be forwarded to the merchant. This is better than a check's promise to pay. Number 5, payment cards have better fraud prevention tools than checks. This industry constantly spends significant funds to minimize the opportunities for fraud. The bad. Number 1, your card is only as accepted as the network it is attached to. Here's an example from Canada where I live. Interac is a debit network based in Canada. An Interac card works at essentially every terminalized face-to-face merchant in Canada. But it has a tiny acceptance footprint in e-commerce and internationally. To work around this, most banks in Canada now dual brand their debit cards with an international network in addition to Interac. Number 2, the infrastructure required to support payment cards is expensive. This aspect has become a lightning rod of criticism against the cost of accepting payment cards. However, analysis will show that a large percentage of those costs are currently unavoidable. Do payment card processes and fee structures need to be updated? Definitely. But carefully, as this payment method requires an expensive infrastructure to operate well. Number 3, as so much money routes through the payment card networks, a fraud industry has sprung up and matured in this payment space. Fraud prevention and mitigation is a significant cost to the industry. If that money were not spent on fraud prevention, fraud could quickly jeopardize payment cards as a reliable and viable payment method. The ugly. 1, the ill will between partners in the payments industry is a knife thrust to the viability of this industry. Each party, issuer, acquirer, cardholder, merchant, has a death grip on what they currently get out of the card payments. This lack of trust and cooperation between the parties paralyzes potential life-saving restructuring of the processes and fees. In absence of that cooperation, in several markets, this payment method is being regulated by governments. These governments don't understand card payments business and have proven they can't run their own business profitably. Number 2, ubiquity. Ubiquity seems like a positive, and it is to merchants and cardholders. However, history has shown that large companies that own a market get lazy on innovation, sloppy on execution, and ripe for replacement. I find the card payment industry to be at this tipping point. E-transfers are also known as account-to-account transfers. They allow the transfer of funds from a funded account, one with money in it, like a checking account, to a recipient account. As a recent innovation, e-transfer leverages existing distributed technology. That's a fancy way to say it uses our cell phones, tablets, and PCs, which we already own, instead of relying on dedicated POS terminals and dedicated networks like payment cards do. The good. Domestic e-transfers, at least in Canada, are good. Number 1, Canada has a good domestic e-transfer product through Interac. The product is fairly intuitive. It rides on the online banking apps that many Canadians are comfortable with. Number 2, domestic e-transfers in Canada have become a standard for person-to-person transactions. Many small businesses are now getting on board, allowing customers to pay via e-transfer. Some larger corporations even offer e-transfer as an invoice payment method. Number 3, domestic e-transfers in Canada have lower costs for merchants than payment cards, checks, or cash. Number 4, unlike cash, e-transfers provide documentation as part of the transaction. The bad. 1. Domestic e-transfer is not ubiquitous. Unless both the sender and recipient are set up for e-transfer, you can't pay with this method. Number 2, this method requires technology to function. Here in Canada, access to online banking through cell phones, tablets, and personal computers provide that infrastructure. Number 3, though the transfer can be confirmed in 5 to 15 minutes, there's no immediate guarantee of funds message for the merchant as there would be with cash or payment card. The ugly. International e-transfer products are the ugly. Number 1, they're very expensive. The international funds transfer market has been dominated for decades by very expensive money transfer companies. For fees that I find exorbitant, they allow me to send funds to many, but not all places in the world. Over the past decade, the international card payment brands have entered this market. Unfortunately, their pricing competes against the terribly expensive incumbents and is hindered by their own significant fees, costs, and profit expectations. Number 2, lack of trust. While banks feel significant comfort in domestic e-transfers, they feel very uncomfortable approving international e-transfers. The decline rates are rather high. Number 3, lack of ubiquity. International money transfer products are limited as to which countries, currencies, and account types they can handle. I understand the challenges these products face and why ubiquity is so hard to attain, but that doesn't make it any less ugly. Financing provides a purchaser a loan to split a large purchase amount into smaller scheduled payments. These payments may be weekly or monthly and may include either an upfront fee or an interest component to the scheduled payments. The good. 1. Financing allows larger payments to be broken into smaller, more manageable payments. Number 2. Someone makes a revenue stream from the interest associated with the financing loan. Maybe the merchant, maybe a finance company, or a bank. Number 3, in some cases, the interest due on the payments is less than the interest earned on investments, like in a store's Don't Pay for a Year promotion. This can be a good payment option for a significant purchase, as long as the loan is paid off before the interest fees start. The bad. Number 1, there's an ongoing cost to the customer for this purchase. Though regulations require disclosure of the fees, too many people who take advantage of this payment method do not understand the implications of the disclosed fees. Number 2, there's a unique risk with debit financing. The customer is promising to pay future expenses. Unfortunately, the customer cannot guarantee their current income will continue unabated into that future. This creates a risk of the customer defaulting on the loan. The ugly. 1. The need for financing, especially for smaller ticket items, has been a warning siren of an economy tottering towards the collapse or significant devaluation. I remember hearing of a financing solution in the country, loans so people could purchase groceries. Yes, that country was soon in the headlines for its economy's precarious position. Number 2, deceptive marketing practices. Last year, I purchased a house where the furnace and air conditioner had been replaced 5 years before. The homeowner had signed up for a 10-year financing plan. The loan allowed prepayment, but the terms of the prepayment required paying all the payments still due, plus a fee to prepay the loan. As a part of the house sale, they had to pay the loan provider twice the value of the units to discharge the loan. That was ugly. There, we've covered all 6 of the payment methods. As you can see, each payment method has unique scenarios where it shines. Each builds on the strengths of previous payment methods, and each has its own good, bad, and ugly. This information will be important as we continue to lay the foundation for your understanding of the card payment industry. In the comments below, let me know any additions you have to these lists. Watch for my next video coming soon to this channel. If you found this video helpful, please click the like button and subscribe to this channel. If you have more questions about the payments industry, leave a message in the comments below. You can also contact me through my website, mentoredbymarkt.com, or via email, markt@mentoredbymarkt.com.